Hi Dharmo, thank you for joining us today. We have seen how the first 3 quarters of 2022 has been very challenging for investors. But in the last quarter, we have seen moderating inflation coming back. We have seen China's reopening as well. So how have our portfolios actually performed in the fourth quarter?
What we saw was a very sharp rebound in financial market in the fourth quarter because of the fading inflation expectation. Investors expect that central banks would slow down the pace of interest rate hikes. And of course, the reversal of the COVID restriction in China sort of boosted investor sentiment for Asian equities, and that has a spillover effect on the rest of the world as well. Because of that, we actually saw decent performances out of the robo portfolios. Overall, what we saw was about minus 0.1 to about 2.2% return from the portfolios, depending on the risk profiles. And within that, basically the moderate to more aggressive portfolios actually performed better because they were allocated more to equities and participated more in the rebound. Whereas for the fixed income side, basically it was a small return, but the weakening of the US dollar actually sort of dragged down the performance of fixed income in the fourth quarter.
Thank you, Dharmo, for giving us a brief explanation in terms of how the portfolios have performed. So with that in mind, could you also share with us whether is it our portfolio allocations have contributed positively to our outperformance of the portfolios, or even to the underperformance of the portfolios as well?
Well, I think we participated in the Asian recovery. Most of the portfolios would have exposure to Asian equities, and that has boosted the performance. I think that's probably on the positive side. But if we look back, what we've done was that in the last quarter, because of the huge volatility in Asian markets, we've sort of constrained that exposure a bit. As well, on the other hand, we did allocate a bit to Europe, and that sort of contributed positively as well for some of the portfolios, whereas the US equities sort of slightly underperformed the rest of the world.
So with that, do you think there will be any further changes going to the portfolios in this quarter as well?
Well, given that equity markets have done very well in the last couple of months and the current market volatility, what we've done is actually we will be cutting the equity exposure for most portfolios. This is also in line with our house view of going overweight fixed income, as we think that bonds have actually priced in most of the rate hikes and probably would perform relatively well going from here. Whereas the outlook for equities are probably a little bit more uncertain. That depends on whether we have a deep recession or not. And given that wide spectrum of possibilities, and as a result, the expected volatility, we've actually reduced risk for most portfolios. However, except for the most aggressive portfolios, what we've done is we've allocated the fixed income portion to Asian high yield. That's really the most aggressive part of the fixed income spectrum. And we believe that this can actually deliver almost equity-like returns for investors.
I guess we have a better picture of how our portfolios are working towards 2023. So what kind of advice will you be giving to our investors going into this new year?
Well, given the double-digit sell-off in equities and bonds last year, our study shows that actually the longer-term expected return for all asset classes have actually gone up. So which means that we think that it's a good time to invest today, albeit that there'll be probably greater volatility in the next several months. Right? So our suggestion, our recommendation is for investors to really look more into the long term and basically stay invested, and if possible, even dollar average your portfolio to meet your long-term investment objective.
Thank you, Dharmo, for joining us today. Really appreciate it.
Thanks for having me, Roger.